Tax is an incredibly confusing subject area that seems to get uglier the more that time passes. And yet, it's essential for investors to learn. Without an understanding of how taxes work, you'll likely find yourself paying more than necessary. So what kinds of taxes do we see when investing? And how can we be tax efficient with our holdings? We'll answer these questions and more on today's Plain Bagel. For young adults entering the workforce, taxes may seem like a relatively straightforward concept. Money is deducted each paycheck, and once a year you file your taxes to tell the government how much you owe them. Actually, filing your taxes can be a bit complicated, but there are programs out there that have dramatically simplified the process. Unfortunately, as you grow your wealth and begin to invest, you'll at some point realize just how complex the tax system really is. The whole thing is chock full of rules, workarounds, exemptions, and restrictions, and it's almost impossible to cover the topic comprehensively. Luckily, there are some key concepts that you can learn to get things started on your investment journey. These include the lowdown on basic investment taxes, as well as how to use registered accounts, such as RRSPs and TFSAs. Or if you're in the States, Roth IRAs and 401ks. While the general concepts of this video will be applicable to the US and other countries, some details will be specific to Canadians, though I'll do my best to highlight when that's the case. So let's start from the beginning. What kinds of taxes do investors need to pay? Well, as you're probably aware, there's your income tax, or taxes paid against your salary, which in Canada and the US follows a marginal tax system, a kind of progressive tax. With marginal taxes, your tax rate for each additional dollar earned increases as your income increases. The tax rate you pay depends on your income tax bracket that you fall into, though your marginal tax rate, or the highest tax rate that you reach, isn't the same as what you actually pay. One way to better understand how it works is to think of the tax system as a measuring cylinder that you fill with the money you make. The money at the bottom, in the lowest bracket, is taxed at the lowest rate. And likewise, the other piles of money are taxed depending on the bracket they fall into. So, the actual tax rate you pay, or your effective tax rate, will be some weighted average of these bracket taxes. Now, your salary isn't the only thing contributing to this graduated cylinder. Payments from your investments, such as interest payments from bonds, are also taxed at your marginal tax rate. In fact, these payments may actually push you into another tax bracket, since it increases your annual income amount. Dividends received from stocks are also taxed, though they receive a more favorable tax rate, since in Canada they offer a tax credit, which you can think of as a sort of tax discount. This tax credit reduces the amount of taxes you need to pay on your dividends, though the size of the credit will depend on some specific dividend details. Other investments, such as REITs and private investments, also face different tax treatment, though to save time I'll leave a link down below that you can check out for more on the topic. Now, unfortunately, income tax isn't the only tax you pay with investments. Investors are also charged something called a capital gains tax, which is a bit more complicated to figure out than income tax. A capital gain is the difference between how much you bought and sold an investment for. So if you purchased a stock for $100 and sold it for $150, then your capital gain, which is taxed, is the $50. The taxes you pay, however, are based on your net capital gains for the year. In other words, if you made $50 on one position, but lost $40 on another, then you'd only pay taxes on the remaining $10. While it may be discouraging that you have to pay taxes virtually every time you make money, capital gains actually receive favorable tax treatment. Specifically, in Canada, if you avoid buying and selling investments within the same year, then your capital gains tax rate will be half of your marginal tax rate. So, income tax and capital gains tax are the primary taxes you'll run into with publicly traded investments. While there are other taxes out there, such as business tax, this is a great starting point to begin a discussion on tax efficiency. You see, taxes are costs that directly diminish how much money we keep from our investments. So we should look for ways to reduce the impact it has on our wealth. Being tax efficient entails both minimizing how much you owe to the government and delaying when taxes are due. While delaying taxes may initially seem arbitrary, it makes sense when you take into account the time value of money. The time value of money is the idea that money today is worth more than money later down the road. This means that $1,000 today is more valuable than $1,000 a year from today. Why? Well, simply put, having money earlier provides you the option of using said money for longer. A very basic example is that you could place the $1,000 received today in a savings account and have more money in a year's time. If you instead received the $1,000 in a year's time, then you would not have earned the extra savings account return. So it only makes sense that we'd want to receive money as early as possible. And likewise, we want to delay owing money, such as through our taxes, when possible. So what are some ways in which we can be tax efficient? Well, there are an endless number of strategies investors can utilize. Tax loss harvesting, for example, is a strategy whereby investors sell their capital loss positions, or positions that lost money, in order to reduce taxes in their current year, only to buy the position back after a certain period of time has passed. But probably the most important source of tax efficiency to cover for beginners is the registered account. Now, investment accounts aren't in and of themselves investments, but rather a vessel within which you hold your investments, kind of like a basket. The standard investment account is known as a cash account, and it pays taxes as they're accrued. Registered accounts, on the other hand, are investment accounts that receive special tax benefits, which can greatly improve your tax efficiency as an investor. A common registered account for first-time investors is the tax-free savings account, or TFSA. The TFSA is a tax-exempt account, much like the Roth IRA account in the US. Income or capital gains earned within a tax-exempt account are, well, exempt from taxes, meaning you keep everything you make even when you withdraw from the account, so long as you follow certain requirements. This greatly improves how much your investments can grow, since it removes a tax drag on your returns and allows for greater compounding, which can make quite the difference over time. As you would probably expect, there is a cap on how much you can put into a TFSA. Your contribution limit for a TFSA account is based on your age, and it increases by about $5,500 each year after you've turned 18, though the annual amount can and has changed from year to year. Another very important account for tax efficiency is the Registered Retirement Savings Plan, or RRSP, which is similar to the US 401k account. The RRSP is a tax-deferred account, and it's a bit more complex than the TFSA. Firstly, the amount you contribute to an RRSP is not taxed at all, not even from income taxes. In other words, contributions directly reduce your taxable income for the year. If you made $50,000 from your job and contributed $10,000 to an RRSP, then you'd only owe income tax on $40,000. This essentially gives you bonus money to invest, since you receive part of your salary tax-free, which allows for greater compounding. Additionally, you don't pay taxes on your capital gains or income so long as the investments remain within the account. Taxes are only paid once you withdraw your holdings from the fund, though it's hard to withdraw your money before retirement without penalty. The great thing about RRSPs is that they not only delay taxes, which as we know is great from a time value of money perspective, but they can also decrease the net amount of taxes you pay over time. If you contribute enough to lower your marginal tax rate in the years that you earn the most income, and then withdraw money in your retirement when you theoretically make no money, then you'll reduce your effective tax rate by spreading out your income received over a longer period of time. RRSPs also have contribution limits based on your level of income. In 2017, for example, your contribution limit was 18% of your 2016 income, plus all prior unused contribution space. Registered accounts are a great way to grow your investments, as they provide a significant boost to the compounding your holdings can achieve over time. While you would ideally have both at some point, TFSAs are a generally better option for first-time investors, as they are easier to withdraw money from, which can be important for someone just starting off. Now, despite our simplified approach to the topic, taxes are a lot more complicated than I may have made them seem, and there's no way we could have covered it all. But this knowledge should be enough to get you started, which, according to the time value of money, is one of the most important aspects of investing. You'll have to pick up more as you gain investment experience, but these small tidbits of information can go a long way in helping you reach your financial objectives. And with that said, we're out of time. If you like this video, please hit the like button, and if you like what we're doing here, please subscribe. If you have any feedback or topics you'd like us to cover in future videos, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.